Okay, so what's the second big landmine that you want to watch out for when you're getting involved in a syndication? And this is the class of syndication that it is. What are they investing in? So I'm going to tell you the two big ones to stay away from, and then we'll get into some of the finer details. So the things that you want to avoid. Right now, you want to avoid construction and development at all costs. Why? Because in times of recession, banks tighten up. We've actually seen this in a rehab project that we were involved in, but luckily we planned according to it. So what happens is when the economy starts to tighten, banks will say, okay, we guaranteed you $500,000 in construction loans or rehab loans, but things aren't really that good right now. We're not going to be able to deliver on that, or we're going to have to slow down the process. You saw this during 2008 and 2009. If you guys remember, in Las Vegas, they were building City Center Aria, which was at the time the biggest casino project. The company that was building it was perfectly fine. They had no problems. They didn't have a foreclosure. They didn't have any credit problems. But the bank said, whoa, we can't finance this right now at this time. We have to hold everything. Well, a year into the holding process, they were paying all the fees and all the fines and everything that needed to be paid to hold that. And they couldn't continue doing it because they were losing money. They had to sell part of the project to the Chinese. The Chinese came in with the money and they finished the project. But this was caused by investing in the wrong asset class. So construction and development, you want to stay away from at all costs. The other thing you want to avoid right now are luxury properties. Now, in general times, luxury can be a great place to park money for tax benefits. You're not going to get a lot of cash flow off of it because they're brand new. But right now, especially, they're seeing higher rates of vacancies because we're headed into a recession. Now, who knows how long the recession is going to last? I think it'll last at least a couple years, and we're going to see people having difficulty. That means they're not going to be in A-class or B-class properties. Most people are going to head towards the C-class properties, which is what thrives during a recession. During normal times, C-class does very well, but during recessions, it booms. There's usually a waiting list to get into those properties because it is the cheapest, safe place to live. So getting into details on this, I'll go through all the different class of properties. A-class are your brand new builds, awesome amenities, high ceilings, great locations, and everything you could ever want. This is usually corporate executive level housing. It's usually about double the price of C-class. B-class is those same buildings that are now maybe 10 years old, or a C-class property that they've gone in and they've added a ton of amenities to, usually because it's in a great location. So B-class is one step down from A, good amenities, and it's usually 25 to 40% more expensive than C-class. C-class properties are your bread and butter. They're safe. They're in decent locations. They're not in the best locations. They have some amenities, but not all the amenities. They're usually somewhere between 15 and 20 years old, and they are great properties for investments for a couple reasons. A-class, it was just built. There's nothing you can do to get the NOI up. If you don't know what NOI is, it's net operating income, and it's where the real income, like the real money, is made in multifamily because it's what appreciation comes from. So A-class properties, there's no NOI, there's nothing you can really do to improve the property. You're not going to make a lot. B-class properties, you'll make some cash flow, but again, there's not a lot that you can improve on. C-class properties, we can go in and we can do countertops, kitchens, bathrooms, raise the NOI by a pretty solid percent, especially when there's wait list, which pushes the appreciation up, which makes you more money. Now you might say, well, if C is so good, wouldn't you go to D? Well, D are the C-class properties that are now 25 to 30 years old. They're starting to have some issues. They're very dated on the inside. And there's, even with new kitchen countertops, new bathrooms, there's not much you can do to make it really nice because of the layouts or because of the size of the rooms or because of the location. So I would stay away from D-class properties. It's going to be your lower income people living there. They're usually rougher. They're harder to clean up. That's not where you want to be. And then last but not least is F properties. F are like war zones. You want to stay away from them at all costs. So landmine number 2 is don't invest in construction or development loans or any of those projects right now. Chances are you're going to run into a tough period where you're either going to have your money held or they're going to have to do a capital call to raise more money. You also don't want to be in A or B class properties right now. You want to be in a solid C class investment.